So I'm going to take you into the last hour of trading. And revisit that final hour macro. And a macro is a short little list of instructions or directives for an algorithm to run, and they tend to repeat. The only time that you're going to see them not work is when we have already moved a lot in either the middle part of the day or right after lunch. It does whatever it was supposed to do in terms of running for liquidity. And then the last hour can be just listless, choppy, not really doing too much at all. But I want to show you how the algorithm uses certain elements of price action and trigger points for how to determine standard deviations within a small micro market structure. And I know that's a whole lot, okay, but I promise it's a lot easier when you see it discussed. Here is that upper quadrant level of that 15-minute fair value gap. Okay, remember, here's that 15-minute fair value gap from the 9th of February that I just talked about before we went down to the lower time frames. This is the midpoint of that. Okay, this is the lower quarter of it. This is the low. This is the high, and this is the upper 25% of that range. So if you would take a fair value gap and split it into 4 pieces equally, if you're bullish, you really don't want to see it trade down to consequent encroachment, but you're allowing that to happen. That your analysis allows for that. If it's really bullish and it comes down and touches this level here, you want to see that then support price. Do we see that here? And it rallies away? Yes, we do. What is this short-term high right here? If I move this out of the way, I'm just going to move it like that. This short-term high, when price runs through it, right there. That candle's high comes in at 41.37.5. This high here comes in at 41.37.5. That candle, when it touches it just like that, you're watching to see is the next time it trades one tick right above that price, you now have a bullish market structure shift for the last final hour of trading. We get that right there. Notice the candle didn't close there. It went above it and came down here. Look back from that candle's high all the way to the low. I'm going to zoom out a little bit so you can see it. What do you see between this low, and I got to make sure I get this done, between this high, and this high here, and that low? Well, you have to refer the 2 down closed candles here. That's a bullish order block. It's one block of price action. Half of that is essentially about right in here. When this candle pierced this high here, looking back, we have this, which is what? Volume imbalance. Then we have a fair value gap right there. Do we want to see it trade back down inside this fair value gap once it's left it? Because we hit this one here. Why would we want to see it come back down and touch it? Because it's already done so here. Would it indicate that it's extremely bullish if it went back down there again? No. So we want to use a array, a specific element in price action that we would be more sensitive to see buying occur. Not that the buying is occurring here to send it higher. It's just that it's repricing back down to this candle's close. That comes in at 41.35 even. And the difference between that and the candle's opening next is 41.35 and a quarter. So we're only talking about 1/4 or 1 tick in difference in terms of price. So we have this volume imbalance. This would be your macro. What time is this candle touching the volume imbalance? 3:18. And this one before is 3:17. So what time is that? Between 3:15 and 3:45, that's your final hour macro. That's exactly what I taught you. And you're expecting what? Price to run to what? Buy side. We're bullish. It can go back to this level here again, which is what I gave you before we went there yesterday morning. So what's above here? Buy side. So buy side's resting there. I'm going to take these dividers off real quick because I only have a couple minutes left and I want to get through it and you can see it. So this run from this high down, remember I was teaching with market structure, institutional market structure, and using it and coupling it with what? Liquidity pools. If we use this drop down, this is a trigger point for running standard deviation, meaning your fib, you anchor to the low up to this short-term high. Why that one? What's this the high prior to the retracement back down to an area where we would expect price to rally? Your standard deviations are noted here. There's your buy side. So which one are you looking for? It has to go above it. So which one are you looking for? 41.50 and even. So 41.50 even. And the final candle here at 1600, which is 4 o'clock, you want to have your position squared by then. What's the high of that candle? 4150.25. That's one tick. I taught you over the weekend that the market likes to remove mohawks. It wants to have a seamless delivery. It will not always stop right at the tick. Why? Well, you have the bid and the ask you have to worry about, much like you saw me fall victim to last week when I was trying to do a finesse and exit at 41.0. I forgot what the price is now off the top of my head. I was off by one tick. It printed the price I wanted, but it didn't give me the exit. And it came back and rolled on my stop on that final single contract. This run from here to here, okay, you have to couple that with narrative and you have to couple it with liquidity. For instance, like what's over here? You have an old low. And if it's up here, taking buy side with this run, and it's dropping down, remember that 15-minute fair value gap? We took out what here? A short-term low, meaning what? We have a shift in market structure that's bearish, counter trend. So this is what I mean by traders that use my information. You can be buying and selling in the same day where one trader may be doing primarily one direction within a daily bias, but you can trade without a bias if you understand what liquidity is likely to provide in terms of the next draw. Small little fair value gap, it trades up into that, delivers below that short-term low. Now this may be a shift in market structure for some of you, and this one may not be because you're trading intraday volatility. The market returns back up into what? Consequent encroachment of that 15-minute fair value gap, which is that shaded area here. Remember, I've changed the color. Then it rolls down and attacks the sell side here. Using the same premise here, this is a trigger to start running your standard deviations from the high to that low. Here's your liquidity, or sell side liquidity. If you want to aim for something below that, what's below it? We have the old fair value gap down here. Standard deviation from high to low here. Below that low, we have this one. It hits it wonderfully. This one here is inside of the high end of the fair value gap that's shaded at 15-minute time frame. I know some of you are probably thinking, okay, this is getting really complicated. Trust me, it's fine. It's not terribly complicated. Just you have to see more examples of it. And then here is consequent encroachment. I'm sorry, the upper quarter, and this is consequent encroachment. You don't want to see, if you're bullish, you don't want to see that level hit. You want to see it respected in the upper portion of it because it'll act like what? An institutional order flow entry drill, where it just goes into an imbalance or a fair value gap and then runs higher. Well, you have a short-term low here. It stops right at that quarter point, the upper quarter of the fair value gap that's shaded in gray here. Remember, there's 4 levels to it. The low, first quarter, midpoint, which is consequent encroachment, 75% of the range, and then the high. So if it's going to go down to that quadrant here, which it does here, how far can it go? Using that reference point here, which is a trigger for standard deviations, the algorithm can reach as far as 41.30 and a half. That would be what? Allowing for this level to be hit, but also for anybody that knows the information I'm sharing with you, their orders will fill because of the difference between the bid and the ask. So 41.30 and a half, that could be a target where it reaches for, what's the low over here? 41.30 and a half. And then you get the run here. The shift in market structure on that candle. Volume imbalance to the tick. runs it up to the fair value gap I mentioned. That would be the afternoon hourly, last hour trading's objective. But I wasn't in front of the charts to be able to know about this high. But you know the procedure and protocol is buy sides resting above that, and then it runs right into it there. The last minute of the last hour of trading right there hammers it. 41.50. 41.50 and a quarter. So that allows that limit order that you would potentially have there. It would allow you to book your exit there. So anyway, that's a little bit of advanced topics, just to whet your appetite, because I can't spend the rest of the afternoon with you. I'm only going to be here for a short period for the CPI number and 15 minutes after the opening.